So be sure to come down to Victor for the property investment seminar. We've had one before at Golden Grove. It was an absolute hit. And one of the speakers at that seminar, which was late last year, is with me in the studio today. It's Ryan Martin. He's the site inspector for BMT Tax Depreciation. That's a mouthful. Welcome, Ryan.
Thank you. Thank you for having us again.
Yeah. Now, Ryan, before we sort of get into your background, I learnt a fair bit from you at that seminar, and I've been in the business longer than you've been alive, I reckon.
Fantastic.
In fact, how old are you?
Oh, I'm 35.
Yep, I've been in business longer than I've been in real estate. So for me to learn something was unbelievable. So
fantastic.
Anyway, let's rewind a bit. Tell me about Ryan. Are you from Adelaide? And tell me about BMT Tax Depreciation.
Yeah, absolutely. Born and bred in Adelaide. Lived here pretty much all my life. A brief stint in Scotland with my parents for a year, which was interesting.
Okay.
And then my wife and myself moved to Melbourne for 3.5 years, and 3 years ago we moved back to Adelaide. So based here now and starting the family, and enjoying it being back.
Well, welcome back.
Thank you. BMT is around about 150 staff nationally. So we have offices throughout Australia, all the major capitals plus large regional markets, particularly in Queensland. In Adelaide alone, there's 4 site inspectors like myself who go out and look at the properties and assess them. So,
Right, so now people would say tax, depreciation, accountancy type people, boring. Now, I didn't find you at all boring. I want you to tell those listening who are involved in property what it is that you do that most people wouldn't understand is happening.
Well, I guess from the property perspective, what we do is we can save them through tax deductions by claiming depreciation.
So this is for people who own investment properties?
Correct, yeah. Not the place of residence, has to be an investment property.
Okay, so we're talking about people who've bought residential property and they've got them leased out. And this is the bit that's very interesting for those people. So go for it. How can you? It's
actually commercial as well. So any investment property. So I guess the ATO looks at investment properties as a small business as such. So any expense or any income you have to claim as such. Same with depreciation. In a business scenario, if you have a company car, you can claim the depreciation on that. So what we do at BMT is we go out and we assess, one, the building of the property, and then also the fittings and fixtures within it. So when we go out and we look at the building, depending on the age, we put a construction cost on that building. Now, if we might say, just ballpark figure, $200,000 for construction costs, that client can claim 2.5% of that amount over a 40-year period. So effectively they can claim $5,000 each year as a tax deduction through depreciation just on the building itself. And then obviously there's the assets within that building, things like hot water systems, ovens, stoves, carpets, etc. We put an individual valuation on all those items, and they can claim depreciation on that as well. So you've got $5,000 from the building, and potentially up to approximately maybe $5,000 from the assets within the building for an average $300,000 to $350,000 home.
Now, Ryan, Sylvia and I own quite a few properties, so I'm going to ask you from my perspective.
Yeah, absolutely.
So I'll get some free advice here.
Yeah, for sure.
We own quite a number of buildings, commercial and residential. I don't think, claim depreciation apart from where we've extended the buildings, and we've claimed a depreciation amount on the extension. Now, what I believe is the case is that we could actually go back and value each building, like say for example this building we're in, and look at all of the improvements in it, and then we can claim it. Now, is that correct?
Yeah, absolutely. The current owner hasn't have to have done the renovation themselves. So a previous owner may have done some sort of renovation on the property, and then you've come in and you've added your sort of touch to it. We can estimate on what that renovation would have been worth or would have cost construction-wise, and then we can break it down. So this particular property, if you engaged a builder to do the complete renovation of the property, they would have gave you an overall bill for that property.
That's right.
They probably won't have itemise all the individual pieces within that renovation.
No, it's just like that job,
X amount of dollars. Yeah, absolutely. So
Yep.
what we'll do is we'll pick that apart, we'll do an assessment, we'll come into a site inspection on the property, look at all the fixtures, the fittings, etc., and put individual valuations on those. So a lot of time accountants will grab that X amount, say it's $200,000, and just claim 2.5% of that
on
amount.
the 200.
Yeah.
Okay.
Where what we can do is we can go in and say, okay, maybe 100,000 of that is Division 43, which is, you know, the bricks, the mortar, the construction side of it.
Talk
Yeah.
English. Yeah.
I'm going to just keep it pretty. And the other side is fittings and fixtures. So hot water systems, carpets, all those sorts of things. We can put an individual valuation on those. So essentially, you can claim a lot higher amount of depreciation by breaking it right down, as opposed to just putting a blanket amount on the total renovation.
So in other words, an extension and 200,000. I don't know any extension get done to that. So let's say 350.
Yep.
So $350,000 extension or renovations.
Mm-hmm.
Without your help, the accountants put, because this is what we've been doing.
Yep.
350,000 goes in, depreciated by 2.5%, equals X number of dollars.
Yep.
That amount of dollars is taken as a loss against your income.
Correct. Yeah. So it's an on-paper loss.
Yeah. Now, if you come into that $350,000 renovation, you can pick off parts of that may have a higher rate. So give me an example of a very high rate.
Or I guess something like maybe like a ceiling fan, you may be able to claim it like around about 15 to 20% as opposed to 2.5%.
Right.
So most fittings and fixtures range between sort of 10 to 20%, as opposed to 2.5% if it's classed as an overall part. So
right. So $350,000 depreciated at 2.5%. By the time you finish it, is there an average number that would go up to, to 6 or 7%?
I mean, it can be anything. We can at some stage double the amount of deductions.
Right. Okay.
By breaking it down.
Now we've then watched in these seminars where you've put those figures into your investment, which is what a lot of these companies like Ironfish and that do. And then that changes very substantially the speed at which you pay it off or the break-even point, doesn't it?
Yeah, absolutely. So I guess general rule of thumb, say for a $350,000 house, we could find up to $10,000 per annum in savings, which can equate, simply to around about $60 less in holding costs of that particular property. So it's significant savings just through a piece of paper as such, a report from us.
Ryan, we're going to come back for more in a minute.
No problems.
Now let's go and look at some sold properties, and there's been plenty of them with going, gone.